The cash flow statement is more or less like one of the statements that makes us the component of financial statement that we are to look at. And it is expedient that we know how to prepare this cash flow statement. The statement is talking about the movement of cash, and it talks about cash and cash equivalents that is being utilized by an entity within a business cycle. Usually, the business cycle of an entity runs from, uh, runs for 12 calendar months. It can be from January to December or any of the months that you choose to start your account recognition and when it ends. So it is expected that we should be able to know exactly what transpires with your cash, what an entity is doing with the cash, and all the cash equivalents. And that's everything about cash flow as it were. What is the movement of cash? What you open with and what you are closing with at the end of that period. And then the focus is cash. It's not all about the accounting profit. That's why we always do away with every non-cash item or all other activities that is not part of a financial year cycle activity. What do I mean by that? Whatsoever that is not in line with your trading activity for the core trading activity of an entity for a financial year, we don't consider it. So it's as simple as that. It's also very, very simple to deal with. It's not something that is in any way difficult to handle. So why is it important that we should look at the cash flow statement? Number one, it helps users to know how the profit of an entity is supported by cash. In other words, what is the volume of cash that is in the profit that is made by an entity within the financial year. So it separates the cash from other items that made up the profit for the year. Number two, it shows the liquidity of an entity, that is. It shows how an entity has been able to perform and hold ground in terms of being able to hold cash and the cash equivalent uh, at their disposal within a financial year. When we talk about cash equivalent, we are talking about what exactly can be easily turned to cash, in the shortest time possible. Example is your treasury bills, your receivables, that's the one the debtor is owing you, and then your inventory, as it were. How how quickly you can turn them to cash matters a lot, and that's why we consider them under the cash flow. And then it also helps us to know your level of solvency, that is, how geared you are in terms of how indebted you are as an entity. So it helps us to know your level of solvency. For instance, in there are three categories in this cash flow statement. The financing activities, for instance, tells us the volumes of amount that you pay out or you receive as debt, how much you paid out for loan repayment and how much you have or borrowed, as it were, in terms of debt. So it shows us the level of solvency as well. The number four, the investors, the lenders, managers can use it to make an informed decision, and that's the importance. You can be asked to just, they just put 2 mark question there. Why do we need to do cash flow statement? Why do we need to prepare cash flow statement? What are the importance and the like? So these are the basic importance. Now there are 3 sections in the cash flow statements. The first one is called the operating section, that is the operating activity section. The second one is the investing activities section, and then the third one is the financing activities section. This is also what IFRS 18 has brought to bear by segmenting the center of the profit or loss into these 3 categories. So you have all these subheadings also under your center of profit or loss in the new IFRS 18. preparation and presentation of a financial statement. We have looked at that in our previous classes. So that's that for that. Emmanuel, you want to say something? Please mute your mic if you are not saying anything. Thank you. And these three categories, that's what we shall be looking at here. We have the operating activities, and this talked generally about the revenue activity of an entity, the cash that has been received, the cash that have been paid to the employees, the interest that have been paid, the tax that you pay. So generally this one is talking about the cash you received, for instance, from sales. That's what we call revenue, as it were. And then we have the cash that you paid to your suppliers, your creditors, the cash you pay to your employees, the cashed out and the likes. And then you have the interest that you pay or the interest that you received, depending on the type of company that you are dealing with. For instance, if it were to be a financial institution, I mean, if you are not a financial institution, you are allowed to deal with your interest paid or interest received in the operating segment. If it were to be some other segment, if it were to be some other calculation that you want to make under this operating activity, you can as well take this interest paid or interest received to the investing activity. So it's a matter of policy, it's a matter of choice. Some people will treat interest received or paid in the operating activity, and some others will choose to do it under the investing activity. So we shall look at all of these. I'm just giving an overview, and then we look at the format, and then you know how to deal with it. And then we have the investing activity. This investing activity basically is dealing with acquisition and disposal of non-current assets, that is a long-term asset, as well as investment. So whether you acquire or you dispose, if you acquire, you are going to less it from the cash flow. If you dispose, you add it to the cash flow. Acquisition and disposals of long-term assets, as well as investment. So that is what you deal with under the investing activities. And then you have the financing activity. The financing activity deals with your equities and your borrowings, as your equities and your borrowing. That's what the financing activity deals with mainly. So this will proceed from sale of share. If you sell share or you raise share, you have to recognize the proceed from there under financing activity. If you borrow money, if you raise funds, you have to also recognize it under the financing activity. And then also, if you make repayments on loans, you recognize also under the financing activity. If you also pay dividend, if you pay dividend, you also recognize it under the financing activity. They call it financing because it is what make up your capital as an entity, as it were. So your capital has two major components: the owner's contribution, which we know as entity, as well as the debt portion of it, that which includes your borrowing, as it were. So financing activity is telling us all your activity that has to do with your capital in the business, whereas the investing activity is talking about the acquisition of asset or any disposal of asset during the financial year, and then as well as investment. If there are investment, if you acquire or dispose any investment, you also treat it under investment activity. While the operating activity is basically talking about what exactly transpires with your cash generating activities in terms of your operations, as it were, what you are dealing with, what you are trading in, what transpires. Those are things that you consider under the under the operating activity. Now, There are two methods to present operating activity according to IAS 17. Now, this standard that we are looking at, or this component of financial that we are looking at is being treated as a separate standard, and the standard is IAS 7. IAS 7. So, in the wisdom of IASB, you can actually use two methods to present your operating activity. You have the direct method and the indirect method. So what I'm trying to explain to you is simple. The direct method and the indirect method are used for preparing or presenting operating activity, whereas your investing and financing activity, they don't need any of the methods. They are the same thing. That is why if you are asked to use a direct method to prepare your cash flow, you are it's only going to affect your operating activity. Your investing as well as financing activity status quo remain the same. That is, there are no changes, there are no methods to calculating. It's just direct the way it is. So quickly, let's look at then those direct methods presentations and then the indirect method. The direct methods, for instance, list the actual cash that is received and the actual cash that is paid. It is more or less like this your cash book for those that are used to it, the summary of your cash book. How much of cash was received, and then you less the cash that is paid. So basically that is cash flow. The inflows, you less the outflows from the inflows. That is the direct method. You look at the cash that you receive, and then you take away the cash that is paid from it. That is your direct method. And the format is very simple. This is all that you need to know. If you're able to note this format that I've just displayed on the screen, this is all that you need to know under the direct method. And I want to please implore you that you take everything that is possible within your power to ensure that you understand this particular topic that we are looking at, because in the last 2-3 diets, this has been the number one question, and they have asked that if you use direct and indirect method. This is how to deal with direct method. Cash received from customer first. And how do you calculate cash received from customers? It is your sales plus your opening receivables minus your closing receivables. Very, very simple. Cash received from customers. Normally, you are selling something. You understand? You are into trading, for instance, selling paint. Paint is your core business. If you sell paint to customer, the sales revenue normally should be what you will recognize as the cash that you receive from customer. Please remember, it's different from the credit sales. We are talking about the one you receive cash. So the cash that you receive from customers, from sales, that's number one, plus opening receivables. What did you open with in the year in terms of your receivables? What did you open with in the year in terms of receivables? What the debtors are owing you? And then what do you close it? What do you close with in the year in terms of what the debtors are owing you? So in other words, what we are saying is your cash received from customer is sales plus net receivables. Sales plus net receivables. And what is your net receivables? Your opening receivable minus your closing receivables. Is that taken? Thank you. I know you understand that. Why? We have what we call cash paid to customers. Cash paid to customers. Cash paid to customers. How do you determine your cash paid to customer? Very, very simple also. Is your purchases plus opening inventory minus your closing inventory. Sorry, opening payable minus your closing payable. Sorry about that. So take note of that. Your cash paid to customers or suppliers purchases plus opening payable minus your closing payable, not inventory. Please take note, was a slip of tongue. Opening payables minus your closing payables. That is how to determine your cash paid to customers. And then you have your cash paid to employees. And that is usually your wages plus opening accruals. If there are accrual means the one that you have accrued that you have not yet paid. The one you are owing your employees, you have not yet paid, minus your closing. So, if you want to know it in a short way, cash received from customer is sales plus net receivable. Cash paid to supplier is purchases plus net payable. Cash paid to employees, wages plus net accruals. It's as simple as that. And whereas your net receivable is equals to opening minus closing receivables. And then your net payable is opening payables minus closing payables. And then your net accruals is opening accruals minus your net accruals. So it's as simple as that. Then you less your interest paid, and then you less your tax paid, and then you arrive at net cash from operating activity. It's as simple as this. Any question? Are we still together? Give me thumbs up if you are okay. Okay, thank you so much. That's what I want to be seeing, so I know we are still flowing together. Please, this is the direct method, the way to handle the direct method. Very, very simple. You see, you devoid it. Cash paid to customer, cash paid to employees, other operating cash statement, interest paid, tax paid. All of these are outflows. You less it from the inflows. The inflows is cash received from customers. That's how to deal with the direct method under operating activity. So let's go to the indirect method. The indirect method is also very simple and very seamless. Its own is it is mainly with starting with profit before tax. Profit before tax. I will always advise students to start with profit before tax. But just in case they did not give you profit before tax and you are to start with profit after tax, I will tell you what to do. But this is basically once you are, but there is no way you even have profit after tax and you won't have profit before tax. But what I want to say is this, students, profit before tax should be what you start with under the indirect method. The other one used to confuse students a lot. That's why I may not even go to that. Start with profit before tax. Then adjust the non-cash items. Your non-cash items include depreciation, profit or loss on disposal, provisions, etc. Then you adjust for working capital, and that talks, please mute your mic. That talks about our inventory, receivables, and payables. You understand? Deduct interest, deduct tax, and then you arrive at the operating cash flow, as it were. It's as simple as that. So just why I put this in bullet, the 4 things to do under the indirect method, just know it, put it on in your head. Every other thing will flow directly. Just know this. Indirect method, start with profit before tax, that is, you put it down. Then you adjust for every non-cash item. What are the non-cash items? Depreciation, receivables, profit or loss on disposals, provisions, and the likes, non-cash items. And then you adjust for your working capital. Your working capital include the inventories, receivables, payables, and then deduct interest, deduct tax. That is how seamless it is. So let's look at the format proper. The first thing first, like I said earlier, is you put down the profit before tax. Then the next thing that you do is to add every of these non-cash items, that is depreciation. You add depreciation. You will add, if there is a gain on disposal, you will, no, if there is a loss on disposal, sorry, you will add it. If there is provisions, you will add it. And then you are going to now less, if there is a gain on disposal, you will less it. Please take note of what I've just said. Very, very important. Take note of what I've just said. Number one is depreciation. You will add it. If there is amortization, you will add it. If there is provision, you will add it. If there is a loss on disposal, you are going to also add it. But if there is a gain on disposal, you will less it. Are we together? And then you have, when you have adjusted all of these, what you now do is you have what we call operating profit before changes in workings capital. And then you now adjust for your workings capital. And every increase in all the current assets, you just have to add it up. All of them put together, you have to add it up. You understand? Then every one that increase, you add them up. Then any one of them that decreases, that I'm talking of current asset now, you will less it. Do you understand now? Okay, let's go. It's as very, very simple. You just carry every item under your current assets. Anyone that increases, you will less it. Anyone that decreases, you will add it. Now, how do you measure the increase in receivable or all the items of current assets? How do you measure it? Very, very simple. Your opening, that is what you are starting with in the year, you minus it from your from your closing. If your opening is higher than your closing, what will you have? It means that there is what? There is an increase. That increase, you are going to less it. Once your opening asset is lower, is higher than your closing, it means that there is, apologies please, 1 minute.
I think the lecturer is muted. Maybe it's his network. I can't hear too. I think it's general from the lecturer.
Apologies please.